This is Danny Mckinney, and I want to congratulate you guys and thank you for revisiting uh, Homebuyers University. This is a program that I've created to help home buyers in their process of buying their home and educating them on that process and guidelines from everything from guidelines to uh, what's the best down payment assistance programs, credit, income, the whole nine yards. So I want to thank you guys for coming back. Again, my name is Danny McKinney. I am the creator of Homebuyers University, and I can be reached at dannymckinney.com, or you can reach me at uh, Danny McKinney at Facebook. You can reach me at Diversified Home Mortgage on Facebook. You can also reach me at our Facebook group, which is the Real Estate Wealth Builders, uh, or go to therealestatewealthbuilders.com. With that being said, let's go ahead and jump into this next module. We're going to talk about FHA guidelines or underwriting guidelines, preferably FHA guidelines. We're going to deal with the three most important things when qualifying for a home, which is credit, income, and asset. But in this module, we're going to talk about credit. So let's go get started. First thing you want to know about credit is what are your credit scores as a underwriter, as a lender, as a mortgage broker. First thing we're going to look at is your credit scores when qualifying you. Here are some levels of credit scores that are needed to purchase your home. FHA will allow you to go all the way down to 500, all the way up to 579 if you're willing to put 10% down on your home. Now that's some great information, because most people think, well, I need 700 scores, I need 650 scores, I need above 600 scores. Well, actually, you don't for FHA. Of course, there's some other guidelines that are requirements. If you're below 580, there's some additional things that you're going to probably need, like more reserves, money that you have in the bank outside of your 10%, and just some other things. But that kind of gives you a guideline that, hey, yes, you could buy a home even if you have lower than 580 credit score. The standard is 580, where you put 3.5% down for FHA. Now, conventional, you need at least a 620, and they have 3% down programs, but the standard is 5% down programs. And of course, you can go all the way up to 50% or however much you want to put down on a conventional property. And pretty much on all these levels, you can put down as much as you want to above the listed amount here. But with 620 with conventional, the 3% down programs are like Home Possible or Home Ready, which is Fannie Mae or Freddie Mac programs. They've been kind of tweaked a little bit, but there are income requirements on those, so you can't make over a certain dollar amount. It's almost like a down payment assistance program. They're helping you with 2% of your down payment, so you only have to bring 3%. But so those are the guidelines for conventional. 580 and up, we have non-conforming programs. Well, what is non-conforming? A lot of people are not familiar with that term. Non-conforming means it doesn't conform to FHA or conventional guidelines. Most cases, you're going to be looking at 10% down or more on these programs. And here we're talking about programs where if you don't fit either in FHA or conventional, we have the option of taking you non-conforming, and you may fit within one of their programs. The great thing about it, you don't have MI with those, but you're going to be required to put in a little bit more money down, and the rate's a little bit higher. But if you want to buy and you don't fit in the other two, with those programs, we have like bank statement programs. We have where they just go off of your last 12 or 24-month bank statements for your business, or if you're for your income. Then also they do investor programs. We also do programs where it's stated if you're buying an investment property. Non-conforming also falls within foreign nationals if you're not, or legal alien. We can put you into that program and get you qualified and get you a loan. 640 and up jumbo. Typically, you're going to need for jumbo, you're going to need like 680 above. But there are some programs for high balance. High balance is between conventional and jumbo. Programs that fit within there, all you need is a 640. And 500 and up, FHA or conventional. We can also do second liens. Say, for instance, required you to put 20% down, and you need to get a 10% second. We can help you with that as well. So there are different programs out there that we can help you get qualified for, and but these are the type of credit scores that you're going to be looking at. VA, which I don't have on here, typically does not require a credit score, or they don't look at the credit scores much. If you're VA approved or you meet the requirements and eligibility for VA, credit is not that much of an issue, so they can get credit scores down to the 500s as well. And the main thing they're looking at your eligibility and your ability to pay. So let's talk about credit history and how it's evaluated. Underwriters must evaluate the borrower's payment history in the following order: previous housing expenses, related expenses, including utilities. Okay. Also, installment debt, and then the last thing, revolving accounts. What about mortgage and or rental history? How do they evaluate that? Well, as far as your credit is concerned, they want to know how you pay your rent and also how you paid your mortgage over the last couple of years. Of course, that's important, and it's indicative of telling them how you actually pay, or you possibly may pay, this mortgage. So the mortgagee, which is you, must verify the document of 12 previous month housing obligation payment history through either credit report or verification of rent received directly from the landlord. The landlord with no identity of interest with the borrower, which means we can't take, if your landlord is a family member, then we won't be able to take verification from them. But however, if you have canceled checks, we'll take that. Verification of mortgage payments received directly from mortgage servicer. So we can verify that. Review cancel checks that cover the most recent 12 months. As I mentioned, it's very important that within the last 12 months you have no lates on your mortgage or your rent, because and conventional, of course, you could not get approved if you have any loan lates within the last 12 months. And then there are some extenuating circumstances on FHA. Also under mortgage and rental history, borrower who is living rent-free must provide a letter from the property owner where they are residing, confirming that the borrower has been living rent-free for how long. The mortgage that has been modified must, and this is talking about if you had your mortgage modified. You know, there are a lot of people that were right after the crash in 2008 were going through modifications, and some people are still going through modifications. So that doesn't mean you can't buy a new home or you can't, refinance your home. But there are stipulations where mortgage that has been modified must utilize payment history in accordance with the modification agreement for the time period of the modification determined in late housing period. So that means basically after you have your modification done, they're going to determine how you paid during that modification period. So mortgages in which modifications incorporated deficiencies balance are not considered delinquent. So if they took, say for instance, your payments, you were 4 months behind. So they took that 4 months and they put it into your mortgage in your modification, and you paid your modification on time and you're paying your modification on time, then they're not going to consider those payments as being late. Judgments. Let's talk about judgments. Judgment refer to any debt or monetary liability of the borrower and the borrower's spouse in a community property state unless excluded by the state law created by court or adjudicating body. So a judgment is when you actually went to court and a judge basically said you have a judgment or you fail to pay this, so therefore you have a judgment against you. Otherwise, if it's not adjudicated or created by court, then and if it's excluded by the state law, then it's not going to count against you. The mortgagee must verify that the court-ordered judgment are resolved or paid off prior to or at closing. Judgments of non-borrowing spouse in a community property state must be resolved or paid in full, with the exception of obligations excluded by state law. So that means that even if you don't have any on your credit, but your non-borrowing spouse under FHA, because a non-borrowing spouse's credit is considered under an FHA loan, even if she's not or he's not on the loan, they're going to consider their credit and the debt obligations on their credit. So taking that into consideration, those things must be resolved or paid in full if it's going to affect the mortgage or the loan. Say, for instance, there's a judgment for taxes, or there's a judgment for child support, or there's a judgment for something that's going to attach to the property, and those things are going to have to be resolved. If it's not, then FHA basically doesn't count that in your debt ratio, but they do require that if it's going to affect the mortgage, that it be paid off. A judgment, now here's some exceptions. A judgment considered resolved if borrower has entered into a valid agreement with the creditor to make regular payments on the debt, has made timely payments for at least 3 months of the scheduled payment, and the judgment will not supersede the FHA insured mortgage lien. The borrower cannot prepay scheduled payments in order to meet the required minimum of 3 months of payments. What does that mean? Well, if you've entered into some type of agreement or arrangement to make payments, and as an underwriter, we may say, well, we need to see 3 months of those payments, that you've made at least 3 months of those payments. You can't just go pay those 3 months up and say, well, I've made the 3 payments, so qualify me now. If the arrangement was made, last month and you're trying to close this month, well, you've got to show 2 more months, so you won't be able to buy for another 2 months until you show that you made those additional 2 payments. So you can't just go run and go pay it down and say, well, hey, I've met the three payment requirement. So that's important to know. What about Chapter 7, bankruptcy? Chapter 7, bankruptcy liquidation does not disqualify a borrower from obtaining an FHA mortgage if at the time of the case number is assigned, at least 2 years have elapsed since the date the bankruptcy is discharged. Not dismissed, but discharged. So if it's been discharged and 2 years have elapsed, you can still buy a home. Now, the borrower has reestablished good credit and has chosen not to incur new credit obligations. And of course, that's an additional caveat to it. You can't, I'm through my bankruptcy 2 years ago, but I still got bad credit. Of course, you need to clean up some of your credit and meet the credit score requirement, and then any other obligations that may hinder you from falling within the FHA guidelines. Chapter 7, bankruptcy discharged. An elapsed period of less than 2 years, but not less than 12, may be acceptable if the borrower can show that the bankruptcy was caused by extenuating circumstance beyond the borrower's control. So that's very tricky. It's a case-by-case basis. So if you do have extenuating circumstances which cause the bankruptcy and it has been less than 12 months, as an underwriter, we may be able to manually take that and take it into consideration. And then if you can prove that since then, since the bankruptcy, if it's been less than 2 years, you can show that you established some other credit and you've been able to manage your financial affairs. Chapter 13, which does not disqualify you as well. Chapter 13 is reorganization. Borrower from obtaining, this does not disqualify a borrower from obtaining an FHA insured mortgage. If at the time the case number is assigned, number assignment, at least 12 months of payout period under the bankruptcy has lapsed. So if you filed a Chapter 13, at least 12 months have gone, they will allow you to do an FHA loan. The mortgagee must determine that during this time, the borrower payment performance has been satisfactory and all requirement payments have been made. The borrower must receive, has received written permission from the bankruptcy court. So that's important. You do have to go to the court and say, hey, court, I want to buy a house, or I want to buy another house while I'm in this bankruptcy, and you have to get court approval in order to do that. Chapter 13 documentation. If the credit report does not verify discharge date, and additional documentation necessary to determine if liabilities were discharged in the bankruptcy. The mortgagee, which is you, must obtain the bankruptcy and discharge documents. The mortgagee must also document that the borrower's current situation indicates that the event which led to the bankruptcy are not likely to occur. So that's important. Let's talk about foreclosure. Foreclosure is generally not eligible for a new FHA loan if the borrower had foreclosed or deed in lieu in a 3-year period prior to the date of the case. 3-year period begins at the date of the deed in lieu or the date that the borrower transferred ownership of the property to the foreclosing entity. So that's important because I've had deals where we have to determine when it actually transferred, because sometimes banks and underwriters will say, well, we look here in the and when we look at the title, looks like that property that got foreclosed on that you had, so it was sold to John Doe. It was sold to John Doe 3 years after you bought it. However, the bank took it within those 3-year period. So the question becomes, do we go by when it was sold to John Doe, or do we go by when the bank took it? Well, according to the guidelines, it says transfer ownership of the property. So that means if the bank took it back and the ownership transferred, 2 months prior to selling it to John Doe, so then that's when the clock starts. And if you're outside of that 3-year period from that time that the bank took it back, then you can go forward with your FHA loan. And here are some exceptions. Lender may grant exception to the 3-year requirement if there's extenuating circumstances. That's case-by-case basis. Of course, you have to explain yourself why you need the exception. And then, of course, you got to show that you've reestablished good credit since the foreclosure or deed in lieu of foreclosure. Deed in lieu of foreclosure basically is you giving it back to the bank saying, hey, don't foreclose. Here's the deed. Take it back, and I'm giving it back to you so you don't foreclose. And I don't want to foreclose on my credit, but it's still considered a deed in lieu of foreclosure. But anyway, as far as the exception is concerned, you can have extenuating circumstances. Foreclosure exceptions, also divorce in itself is not considered an extenuating circumstance. So you can't claim, well, my husband beat me and I had to leave, and that caused us to go into a foreclosure. That's not extenuating circumstances. I had to go through a divorce, so that's not extenuating circumstances. Basically, you have to explain something outside of your control that caused you to go into it, whatever that may be. It's like I said, it's very tricky. Some underwriters will take it, some won't. You have to understand from an underwriting standpoint, they don't want to be caught on the hook if this deal goes bad, because they go back to the underwriter like, why did you underwrite this loan? And underwriters could be, in effect, held responsible for underwriting a loan that wasn't done properly or underwritten properly. So it's very important. So I know when we're buying homes, we don't sometimes understand why are we having to jump through these hoops, but underwriters have to look at things like from that perspective, like why, if I approve this loan and there's some questionable stuff on it, they already had one foreclosure and, it didn't make any sense to them, then they're gonna definitely scrutinize your file. And then if you do fall within an exception, that exception possibly will be scrutinized as well. So also, the inability to sell the property due to a job transfer or relocation to another area does not qualify extenuating circumstance. So you lose your job or you get transferred or whatever, that's not considered extenuating circumstance. Short sale. If you understand what short sales are, basically you've sold the property to a third party and you've asked the bank to take lesser amount because either the value has gone down or you can't pay off that loan with the typical sale of that property. Uh, well, a borrower generally is not eligible for a new FHA mortgage if they relinquish the property through a short sale within 3 years from the date of the case number assigned. So if there's a case number assigned for short sale, you have to wait 3 years. The 3-year period begins the date of the transfer of the title by the short sale. So until you once you sell that property on the short sale, in 3 years from there, you can buy another another property. I think that has kind of changed to a certain extent, but pretty much those are the guidelines on that. A borrower is considered eligible for a new FHA insured mortgage if the date of the case number signed for the new mortgage. All mortgage payments on the prior mortgage were made within the 12-month due for the 12-month period preceding the short sale. Installment debt payments for the same time period was also made within the month due. So basically, here's an exception. If you're paying your mortgage and all of a sudden you look, this house is underwater and I'm not going to live here anymore because I got to get rid of it and I'm paying something that's underwater, then they've made some exceptions for you. And as long as you're a credit and you've been paying other things on time and you paid within the last 12 months of selling your property, you paid on time, and you just say, hey, I just got to get rid of it, then they will reconsider that, typically under a manual underwrite. Credit counseling programs. Participating in consumer credit counseling programs does not disqualify a borrower from obtaining FHA mortgage, provided the mortgagee documents that one year of payout period has elapsed under the plan. So what does that mean? They used to be, and there still are programs where you go into a government assistant program or counseling program where they'll help you work out a payout plan to help you get out of debt. And as long as 1 year has lapsed under that plan, you can qualify for a home under FHA. The borrower's payment performance has been satisfactory, and the borrower has received written permission from the counseling agency to do so. So I haven't heard a lot of people going to these counseling programs recently, but I know years ago that was a big thing. Closed-end debts do not have to be included if they will be paid off within 10 months, meaning what they call installment payments. And then the cumulative payments of all such debts less than or equal to 5% of the borrower's gross monthly income are not typically included in your credit. Borrower may not pay down the balances in order to meet the 10-month requirement. So what does that mean? So if you have an installment account, not a revolving account, but installment account, and you're able to pay that, you only have less than 10 months left, then they're not going to count that into your debt. Authorized users. If you understand what authorized users are, is if basically someone signs or allows you to be an authorized user on their credit, that program, they allow you to just add your name on their credit card as an authorized user, and then typically that credit now appears on your credit. So if they've been paying that account for the last 20 years and they've been paying it perfectly, then that perfect credit goes onto your credit Accounts which borrower is authorized and must be included in the borrower's DTI unless the mortgagee can obtain documentation to evidence that uh, I just want to make sure that we're not skipping anything. Uh, DTI, unless mortgagee can obtain documentation of evidence that the primary account holder has made all the requirement payments for the previous 12 months. Uh, and if less than 3 payments have been required on the account in the previous 12 months, the payments must be included in the borrower's DTI. So basically, although you're just an authorized user and mama let you put your name on one of her credit cards, and that typically will help your credit scores, um, they're still going to count that into your debt. So if that credit card is $100 and and you're an authorized user on it, well, that's your debt now too. So they're going to count that into your debt ratio when determining how much you qualify for. So it's important. It's okay to have be an authorized user. People do that to help boost their score sometimes, but also take into consideration that debt is also going to be factored in, uh, and in DTI, or possibly may be factored into your DTI. Credit report inquiries. Mortgage must obtain a written explanation for borrower for all inquiries shown within the report within the last 90 days. So therefore, when you get ready to close, they're going to ask you for a letter of explanation of why you obtained this credit or tried to obtain this credit in 90 days. So if you have 5 inquiries, you're going to do a letter of explanation for all 5, explaining I got credit or I didn't get credit. If you got credit, what is the credit? Sometimes people will go out right before they close, which is a no-no, and try to get credit. And last minute, when we're doing QC and underwriting to quality control to make sure that you haven't gone out and borrowed money for a down payment or something else, or you now got another $500 payment on your credit, but it just hasn't reported. We see those inquiries, so we want to know exactly why that inquiry was on there and what actually transpired. So, um, federal debt. Okay, federal debt refers to debt owed to the federal government for which regular payments are being made. Mortgagee must include the debt. This doesn't include uh, student loans, but this includes federal debt. The amount of the required payment must be included in the calculation of borrower's total debt to income debt to income ratio. The mortgagee must include documentation from the federal agency, evidence and payments agreements, and verification of payments made. Okay, so what about alimony and child support? Alimony and child support, maintenance, uh, uh, and maintenance are court ordered and otherwise agreed upon payments. For alimony, if the borrower income was not reduced by the amount of the monthly alimony obligation in the mortgagee's calculation of the borrower's gross income, the mortgagee must verify and include a monthly obligation in its calculation of the borrower's debt. Child support, other maintenance and other maintenance are to be treated as recurring liability, and mortgagees must include the monthly obligation in the borrower's liability and debt. So you got child support, or if you're getting alimony or you're paying alimony, um, those things are considered into your debt to income ratio on your credit. So that's going to be something that is going to affect your credit. I know child support does show up on your credit, so that also is going to be something that's going to affect it. Deferred obligations. Deferred obligations include student loans and uh, excluded student loans. Refer to liabilities that have been incurred but were payments and deferred or has not yet commenced, including accounts in forbearance. The mortgagee must verify and include deferred obligations in the calculations of their their debt. Okay, so now installment loans, which are excluding student loans. Oh, I think I've already gone over this. So having little technical difficulty. Okay, there we go. All right, so okay, student loans. So if payments used in the monthly obligation is less than 1% of the outstanding balance reported on the borrower's credit report, or less than monthly payment reported on the borrower's credit report, the mortgagee must obtain documentation of the actual monthly payment and the payment status and evidence of outstanding balance in terms from the creditor. What does that mean? Well, student loans, it doesn't matter what status they are in, they are considered into your monthly payment, which means I don't care if you have a deferment that says, well, because I have an income deferment, I don't have to make any payments. They will, and we must take 1% of your outstanding balance and count that into your debt ratio. And I know I get it all the time, like, hey, I don't have to make any payments. Well, yeah, that's right. But however, the way we look at it is from an underwriting standpoint is when that payment kicks in, then we're going to need to know, are you going to be able to afford this or qualify for this home as if those payments kicked in? So what we do is, if it's not a payment on your credit report, we're going to take 1% of the outstanding balance, whichever is greater. So if 1% or whatever's shown on your credit report is greater, then we take the greater of the two and count that into your debt ratio. Revolving accounts, of course, your credit cards, things of that nature. Revolving charge accounts refer to credit arrangements that require the borrower to make periodic payments but does not require full repayment by a specific point of time. Mortgagee must include monthly payments shown on the credit report for the revolving charge account. Where the credit report does not reflect necessary information on the charge account, the mortgagee must obtain a copy of the most recent charge account statement or use 5% of the outstanding balance of the monthly payment. So what does that mean? Okay, well, if you have some outstanding debt out there, but we can't determine what the payment is, then whatever that outstanding debt is, we're going to take 5% of that amount and calculate that as a debt and your debt payment and factor that into your debt ratio. Collection accounts. Collection accounts are accounts that show and say collection on your credit report. Collection account refers to a borrower's loan or debt that has been submitted to collection or to a collection agency by the creditor. Medical collections are not required to be paid and satisfied. That's very important. We all, have had at some point some medical bill that popped up on a credit report. We have no idea why it's there, and in some cases we do have some medicals. For FHA, we're not going to count medical collections, so it doesn't factor into your debt ratio. Now, collection accounts on non-borrowing spouse in a community property state, such as Texas, must be included in $2,000 cumulative balance and analyzed as a part of the borrower's ability to pay in collection accounts unless specifically excluded by state law. So what does that mean? Well, that means that if you have a non-borrowing spouse, someone who is not on the loan, but they're your spouse, we have to take their debt, their revolving or their collection accounts into consideration as a part of your debt. So, and if it's over $2,000, then we have to take that and factor in a 5% of the amount that's over $2,000 and calculate that as a payment that's going to go against you as the borrower and your debt ratio, even though it's not yours, but it's your borrowing spouse. Because the way to look at it is, at some point in time, that debt could come back to haunt you, or it could be required to be paid off, and so we need to make sure that that's factored into your debt. One way around it is put your spouse on. If she can't qualify because of her credit scores or whatever, then, or he or she can't qualify, then you need to keep them off the loan. Then yeah, they're going to take that into consideration for collection accounts. If the credit report uses an analysis shows cumulative outstanding collection account balances of 2,000 or greater, mortgagee must verify that the debt is paid in full, or verify that payment arrangements have been made. And if the payment arrangement is not available, calculate the monthly payment by using 5%, which I just basically said. So whatever that amount is, if it's over $2,000 or greater than $2,000, then we have to factor those collection accounts into your debt on FHA at a 5%. So say, for instance, $2,500, well, whatever $2,500 times 5%, which should be $125. That $125 will be now a monthly payment for you because you have $2,500 of collection. It's over the $2,000, so we take the whole amount, a cumulative amount, and factor that times 5%, and then that 5%, which equates to $125. Now you have a $125 debt. Although it's a collection account, you're not paying it, but we have to take that into consideration. Charge-off accounts refers to borrower's loan or debt that has been written off by a creditor. Charge-off accounts do not need to be included in borrower's liabilities or debt. Okay, you get that? Charge-offs, medical bills do not count against the debt, so we don't even look at them. So if it's a medical, if it says collection, if it says medical bill collection, medical bill, we don't even count that into your debt ratio. If it's a charge-off account, because it's considered to be an account that's been written off by the creditor, then we don't count that into your debt ratio. So it's always a good thing. Business debt, well, self-employed borrower state debt appearing on the personal credit report is being paid by the business. The debt must be included in the debt to income calculation unless the mortgagee obtains documentation to evidence the following. The company has been making regular on-time payments during the 12-month without delinquency. The debt is paid out of company funds, and the debt was considered in the cash flow analysis of the borrower's business. So basically, if you have business debt, but although it's showing up on your credit report, if your business has been making the payment, you can document it that your businesses, you've been paying it with your business out of your business account, then we can underwrite that as a business debt and not necessarily counted against you. Obligations not considered debt. Here are other obligations that we do not consider debt, or that won't be counted towards your debt ratio. Medical collections, as we mentioned before, federal, state, and local taxes not delinquent and no payments are required. That's not considered part of your debt. Automatic deduction from savings when not associated with another type of obligation, it's not going to be counted against your debt ratio. Federal Insurance Contributions Act, FICA, other retirement contributions such as, that's not going to be considered against your debt. So if you're making these payments or FICA or to towards your taxes or your 401k, that's not considered debt. All right. Collateralization loans secured by depository accounts, that's not debt. Your utility bills are not going to be counted against you. Child care is not going to be counted against you. Community costs are not going to be counted against you. Union dues is not going to be counted against you. Insurance and other than property insurance, other than your property insurance, it's not going to be counted against you. Open accounts with zero balance is not going to be counted against you. And voluntary deductions when associated with another type of obligation. So if you voluntarily are paying on something, but it's not required, you're not required to pay that. Well, we're not going to say, well, you're paying that every month. We need to factor that into your debt ratio. No. So these are the list of things that are not going to be considered, debt obligations against your debt ratio. So taking these things into consideration, these when it comes to credit, these are the things that we look at and consider as uh, credit issues or, uh, or things that's going to be factored against or for your credit when buying your home. So again, I want to thank you guys for coming out. I know that was brief, but we kind of gave you a brief synopsis of the things you need to take in consideration when looking at your credit when buying your home. If you have any questions, please feel free to reach out to us and we'll be happy to answer any questions. Again, this is Danny McKinney. Thank you for being a member of your Homebuyer University, and we look forward to helping you guys. Thank you.